Hello fellow intelligent investors, my name is René Salman and today I want to continue to talk about Mohnish Pabrai's 100 Bagger framework. As I pointed out in my last video, he spoke to students of a university in Beijing quite recently and he outlined 5 types of businesses that can return $100 for every $1 invested. I think his 100 Bagger framework consists of 2 components. We've already covered the first one, the $50 billion rule, in my last video. And in this video I will take a look at the second component of Pabrai's framework. So let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Salman and I'll teach you how you can manage and invest your money with confidence, a long-term vision and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, I think it is fair to say that there is no magic formula to find 100 bagger stocks, to find multi-baggers. If there were such a simple formula, then everyone would do it. Everyone would buy these stocks and consequently drive up prices in the short term, and then the chance to enjoy the returns of 100 bagger would no longer be available. So clearly, every 100 bagger story is a bit different. The businesses might have different CEOs at the helmet of the corporation. Maybe some 100 bagger businesses had multiple CEOs over the years. Management teams might follow different capital allocation strategies that fit the individual company. The outcome of some businesses is probably more predictable than that of others. The size of the total addressable market might differ, and so on and so forth. The authors of the 45-slide presentation called 10x return stocks in the last 15 years looked at various multi-bagger stocks, and they came to a similar conclusion. They wrote the following: there is no magic formula to find long-term multi-baggers. Every case is different, with multiple different factors leading to extra returns, although the quality of management remains key. Best thing is to be curious, humble and read a lot. However, while every 100 bagger story is somewhat unique, it is fair to say that all 100 bagger stocks follow certain patterns. The author of the study I just referenced, for example, pointed out that management's abilities might be a key factor when it comes to becoming a 100 bagger stock. And so these patterns allow investors to classify 100 bagger stocks. And this is exactly what Mohnish Pabrai did when he developed his 100 bagger framework. He distinguished between 5 different types of 100 bagger stocks. So let's have a look at each of these 5 types. Well, Pabrai referred to the first type of 100 baggers as focused mousetraps. And what he means by this is that management is almost obsessively focused on the core business and not willing to spend any time or money on any unrelated business activities. Obviously, these focused mousetraps businesses will need a very long runway if they want or should ever turn into a 100 bagger stock. So ideally, they are still a fairly small business with a relatively small market share, and ideally in a huge total addressable market. And again, in a perfect world, the total addressable market itself is growing at a fast clip too. And in terms of capital allocation, these businesses will reinvest a large portion of their free cash flow back into their core business to fuel high double-digit growth for many years. And a quote from Chris Meyer's book here again, the book 100 Baggers. You'll also see it's a fairly high hurdle to get to 100 bagger status. You need high growth for a long time. For example, Tractor Supply grew earnings at a rate of 23% per year and became a 100 bagger after just over 12 years. Later, we will look at Monster Beverage, a stock that became a 100 bagger in just 10 years. A remarkable feat that required a 50% annual growth rate. And some of the other examples Pabrai mentioned in his presentation were Costco, McDonald's and Chipotle. And other examples that came to my mind would be XPEL or Southwest Airlines. So let's move on to the second type of 100 baggers. The second type of 100 baggers are characterized by an exceptional capital allocator at the head of the corporation. If you want to learn more about these special CEOs that are indeed very rare, I can highly recommend the book The Outsiders, in which William Thorndike teaches his readers through 8 real examples how over time the capital allocation of a company's managers or management makes a significant difference for its shareholders. And again, some of the examples here would certainly be Warren Buffett and Berkshire Hathaway, because they are the ultimate multi-bagger stock. It's not even a 100-bagger, but a multi-thousand bagger that probably deserves its own category. Then maybe two lesser known, but still very skilled CEOs would be the Rails brothers. So that's Stephen and Mitchell Rails, who have exercised their market-beating skills at 2 companies actually, namely at Danaher and maybe to a lesser extent Colfax. And one of my favorite CEOs is certainly Mark Leonard, who is running Constellation Software. If you have never read any of his shareholder letters, you absolutely need to do that now, because they are just phenomenal and probably just as good as Buffett's letters to investors. I can also recommend a new blog post from Chris Meyer in which he discussed Leonard's most recent letter and Constellation Software's decision to actually cut their dividend, which is likely another example of a great capital allocation move. Because usually cutting a dividend is or can be considered a bad signal. But when a highly skilled capital allocator like Mark Leonard makes such a decision, shareholders will likely benefit over the long term. Now, before we move on to the third type of 100 baggers, please be sure to hit the like button and to leave a comment, because any form of engagement is much appreciated and would help me to grow the channel more quickly and reach more people. Okay, a third type of 100 bagger company are what Pabrai refers to as Uber cannibals. So those are companies that are obsessively and ideally opportunistically buying back their own stock. And over time they significantly reduce the total share count. And Charlie Munger himself, he already said, pay close attention to the cannibals, the businesses that are eating themselves by buying back their stock. What's unique about these types of businesses is that they do not even necessarily need to grow at such high rates. Their stock repurchases will actually boost per share profit metrics and can do wonders in combination with a decent level of organic growth. For instance, we have to name NVR and AutoZone here, who just take a majority of their free cash flow and use it to buy back their own stock. In fact, since 1994, NVR actually shrunk its share count by almost 80%. And similarly, AutoZone retired almost 50% of the shares outstanding over the last 10 years. And let me just share this beautiful graph here that illustrates the capital allocation of AutoZone over the last 30 years. It shows that this firm extensively bought back its own stock and, as I said, used most of its free cash flow for share buybacks. The chart was created by Heikki Keskiäväi. I'm sure I mispronounced his name here, but I can highly recommend his Twitter account. Alright, so that's already 3 ways to achieve 100 bagger status. According to Pabrai, a fourth type of 100 baggers are deeply undervalued stocks that are kind of a turnaround investment. And as such, it involves taking a position in a stock that has massively fallen out of favor in a way, often due to bad news, but often there are also profound financial and operational issues. And as a result, these problems or issues will likely drag down the company's stock price. But a CEO might successfully turn around the business and find maybe new avenues for growth, or maybe more importantly, fix existing problems. And as a result of that, the stock price might eventually recover. And one example that came to my mind is Capri Holdings, who's probably best known for the Michael Kors brand. During the coronavirus pandemic, at one point the stock was trading at a price to free cash flow multiple of around 1. And the stock is almost up 10x since then. The core business is actually intact and revenue is growing and gross margins are actually pretty high. So if you bought the stock at the March low when everyone was panicking and hold the stock, say for the next 20, 25 or 30 years, you might actually enjoy a 100 bagger just because the price was so dramatically depressed at one point. And then lastly, there is a fifth type of 100 bagger stocks. And Pabrai refers to these firms as spawners. This was actually the main focus of Pabrai during his presentation, and I actually plan to do another video in which I specifically discuss his thoughts on this topic, because in fact Pabrai distinguished between different types of spawners, but maybe just generally speaking, Pabrai defined these spawner businesses as companies that continuously spawn related and non-related businesses. So in a way, I think you can think of them as the opposite of focused mousetraps. Because while focused mousetraps might feel distracted by any business activity or business operations that are not directly related to the core business, spawner companies are actually or actively trying to spawn new business lines, and they accept a high failure rate. If only a few of these initiatives work out, the overall business will massively benefit and thrive, as these new business lines can be major growth engines. And just to provide one example here, Amazon started out as a book company. And fast forward to today, and today Amazon's web services, so AWS, is actually the leader in the global cloud infrastructure services market, with a market share of, I think, 30%. And the revenue of AWS already accounts for more than 10% of Amazon's total revenue. And as it is a high margin product or service, it accounts for an even higher percentage if we would look at other metrics such as operating income or net income. Now, based on these 5 types of 100 baggers, it can be concluded that you cannot really quantitatively screen for these 100 baggers. Finding them is difficult and extremely challenging, and Pabrai himself remarked in the presentation. Why should it be easy to get rich? As I already pointed out in the beginning of this video, ideally you are just very curious, remain humble and read a lot. I think it also helps to be somewhat active on Twitter because lots of people share their ideas openly on this platform. And many of these ideas would probably not pop up in a stock screener. And with that being said, may your finances and investments prosper. Good luck.